Let's bring in Dreyfus and Mellon, chief economist, former Fed official Vincent Reinhart. Vince, it's great to see you again. Did we make a turn today, at least in shelter?
Yeah, this was an encouraging price print, no question about it. At this point, you're supposed to say, don't make much of 1 month's worth of data. It is volatile. However, we've gotten 4 or 5 months in a row of good CPI inflation in terms of a cooling in the overall trend. Fed's got to be happy about this. The Fed's probably about at the stage where it can say done enough in terms of raising rates. Hence, the probability of a rate hike is just evaporated.
How do they change that language without giving away the store?
So that's the key issue, Carl, and it's in the probabilities you cited. The Fed's strategy, because it doesn't know what the equilibrium real rate is to raise the funds rate to something that's restrictive and then keep it there until they're absolutely sure inflation's back to goal. They're encouraged inflation's heading back to goal, but they can't be absolutely sure. And so while they're not going to raise the rate anytime soon, they're still going to hold it where it is, 5.25%, for a considerable period. Investors are right in taking out the probability of rate hikes. They're wrong in saying that the Fed pivot to ease will be so quick. And that's a real communications challenge for the Fed. They got to say, we're not raising rates anytime soon, don't worry about that, but don't expect cuts anytime soon.
So what would lead them to cut, Vince?
The world's uncertain. The world's a risky place. A lot of bad things can happen. A couple more CPI prints like this in a row where things are cool, and they could say that they've achieved price stability a lot more painlessly and quickly than they thought. But more important than that is the economy rolling over. The fact is, employment gains have still been pretty robust. It's hard to picture that happening immediately, but the economy can turn on a dime. And so if there was a considerable softening in activity, given the inflation progress they've seen, then they'd be willing to change policy.
I mean, it's certainly progress, Vince, but just for the average American, what we're talking about here is still a 6.8% jump in the owner's equivalent rent. So I know it's down from the high levels. Primary residence rent up 7%. Services, which has been the problem, is still strong. I'm looking at the year-over-year numbers, 5.5% taking out energy services. Food costs have come down. They're still rising. My point is, it doesn't feel, we're not in disinflation or deflate. We're not in deflation, I guess, for the average American. So doesn't that mean that the Fed is going to have to stay vigilant, at least on messaging?
Oh, sure, absolutely. And the chair will continue to say what he says at the end of the first paragraph of any of his remarks. We understand the hardship of the American people, and we're going to make more progress in achieving our goal. And at one level, we've moved a level of abstraction that distances ourselves from the average American. Inflation is a more abstract concept. The plain fact is, most people go into the grocery store, see higher prices than they're used to. They see higher prices than 6 months ago, than a year ago, than 2 years ago. And moreover, they see prices are out of whack. Some prices of goods are high, some other prices aren't quite as high, and they have to focus more on those relative prices to figure out how to do their budgeting. That is why inflation is discomforting. The plain fact is, when the Fed lost control of price stability, it made prices salient to households. People had to care about something in a way they hadn't in a while. And it'll take a while for them to get comfortable again with inflation being low and prices being more predictable. It's the unpredictable, chaotic nature of inflation that explains why the American people, i.e. voters, are still unhappy with the current state of economic policymaking.